Stocks versus real estate. Which builds wealth faster? When people talk about building wealth, two big topics always come up: stocks and real estate. Some swear by the stock market. Others insist real estate is the best path to financial freedom. And the truth is, both have created millionaires. Both can change your life, but they work in very different ways. So the big question is, which one actually grows your money faster? Let's dive deep and compare them side by side in a way that makes sense, with simple examples and real-world situations. Where's stocks? When you buy a stock, you're buying a piece of company. Imagine owning one tiny slice of Apple, Amazon, or Coca-Cola. If the company grows and earns more profit, your slice becomes more valuable. You can make money in two ways. One, capital gains, when the stock price goes up and you sell it for more than you paid. Two, dividends, when a company pays part of its profit directly to shareholders. The stock market is like a giant marketplace where millions of people buy and sell shares every day. It's fast, flexible, and accessible to almost anyone with a smartphone and a few dollars. What is real estate? Real estate is property, land, houses, apartments, office buildings, or even farmland. Unlike stocks, real estate is something you can see and touch. You can live in it, rent it out, or sell it. People make money in real estate in two main ways. One, appreciation, when the property increases in value over time. Two, rental income, steady monthly payments from tenants who live or work in your property. Many investors love real estate because it feels more stable and less abstract than stocks. It's a physical asset, not just numbers on a screen. Average returns, stocks versus real estate. Now let's talk about growth. Historically, the stock market has returned about 7 to 10% per year on average. That might not sound huge, but with compounding, it's powerful. Let's do an example. Suppose you invest $10,000 in an index fund that grows 8% a year. After 20 years, without touching it, you'd have more than $46,000. After 30 years, you'd have over $100,000. That's the magic of compounding. Real estate usually appreciates at about 3 to 5% per year on the property value itself. At first glance, that looks slower than stocks. But here's the twist. Real estate lets you use leverage. You can borrow money from the bank to buy a property worth way more than your cash. And while you only put in, say, $50,000, you benefit from appreciation on the entire $250,000 property. Example, stock investment. Let's say you put $50,000 into the stock market. You buy a low-cost index fund, and it grows at an average of 8% a year. After 10 years, you'd have about $108,000. After 20 years, about $233,000. After 30 years, about $503,000. No tenants, no property maintenance, no phone calls in the middle of the night. Just automatic growth. Example, real estate investment. Now, let's take that same $50,000 and use it as a down payment on a $250,000 rental property. You borrow the rest from the bank. Over time, two things happen. The property itself increases in value. At 4% annual growth, after 20 years, that property could be worth about $547,000. Your tenants pay rent, covering your mortgage, and even giving you extra monthly income. By the end of 20 years, you might own the property outright, and it's worth over $500,000. Plus, you've collected rent along the way. That's the power of leverage, using borrowed money to control a bigger asset. Risk comparison. Of course, no investment is risk-free. Stocks can be very volatile. In 1 year, they might jump 20%, and the next year they might fall 30%. Remember the 2008 financial crisis or the COVID crash in 2020? The market can be a roller coaster, but historically, it always recovers and grows long-term. Real estate feels more stable because home prices don't usually change every day, but has risks too. Tenants might not pay rent. Repairs can be expensive. Property values can crash like they did in 2008. And unlike stocks, it could take months to sell if you need cash quickly. Liquidity. This is a big difference. Stocks are liquid. You can sell in seconds and get your money back in a couple of days. Real estate is illiquid. Selling takes time, weeks or months, and you'll pay closing costs, realtor fees, and taxes. If you think you might need access to your money quickly, stocks are better. Diversification. Diversification means spreading your money so you're not putting all your eggs in one basket. With stocks, it's easy. You can buy an index fund and instantly own pieces of hundreds of companies across different industries and countries. With real estate, most people start with one property. That means your money is tied to one location, one neighborhood, one investment. If that area struggles, so does your wealth. Taxes. Taxes play a huge role. Stocks are simple. You pay capital gains tax when you sell, and you pay taxes on dividends. Real estate is more complex but offers more benefits. You can deduct mortgage interest, property taxes, maintenance costs, and even depreciation. These tax breaks can save thousands of dollars each year. That's why many wealthy investors love real estate. The tax advantages can be huge. Lifestyle fit. Another question to ask yourself is, what fits your lifestyle? Stocks are hands-off. Once you invest, you don't have to do much. You can set up automatic contributions and just let time do the work. Perfect for people who don't want to manage tenants or deal with property repairs. Real estate is more hands-on. Even if you hire a property manager, you'll still need to be involved. It's like running a small business. If you enjoy negotiating, fixing, or building, real estate can be rewarding. If not, it might feel stressful. Real-life stories. Let's look at some real examples. Stock investor story. Imagine someone in their 20s who invests $500 every month into an index fund. By the time they're 60, they could have more than $1 million, even without ever touching real estate. Real estate investor story. On the other hand, someone buys a 4-unit rental property at age 30. Tenants cover the mortgage. By 50, they own the property outright, and it brings in thousands of dollars in monthly rental income. Plus, it's worth much more than they paid. Both paths can lead to wealth. They just look different. Which builds wealth faster? So after all this, which one really grows faster? If you want faster passive growth with less involvement, stocks usually win. If you want cash flow, tax breaks, and leverage, real estate can outpace stocks. But here's the truth. The wealthiest people often invest in both. They use stocks for liquidity and steady growth, and real estate for income and stability. Together, the combination is extremely powerful. Final thoughts. So should you choose stocks or should you choose real estate? The real answer is choose the one that matches your personality, your financial situation, and your goals. If you're someone who wants things simple, automatic, and hands-off, start with stocks. If you're someone who likes control, enjoys property, and doesn't mind some work, real estate could be your path. And if you can do both, build a stock portfolio for growth and buy real estate for income. That's how you create long-lasting wealth. At the end of the day, building wealth is less about picking the perfect investment and more about starting early, being consistent, and staying patient. Whether it's stocks or real estate, the key is to take action and stick with it. Because the real secret isn't stocks versus real estate. The real secret is time.